Vikram sir, please go ahead.
Okay, great. So thank you so much, for participating in this masterclass, which is on startup and investors beat. And we would like to thank SOCHAM and Mighty for really, organizing this. And this is going to be a set of webinars going forward on the same topic. And today we have a very well-renowned set of speakers here, and we'll be hearing from each one of them shortly. And the format we're going to follow is we're going to give about 10 minutes or so to each of the speakers, who will share their views on their understanding of the current situation, and also the fundraising environment, and how the startups can actually really use this as an opportunity, or really look at the scenario in terms of how the investors are looking at startups, etc. And we do have a very diverse set of panelists who come from different backgrounds, including people who are investing actively. We also have people who have been advising startups and investors alike. And we would want to start the session with Mr. Pankaj Makkar, who is the Managing Director of Bertelsmann India Investments. He would do the inaugural session with his comments. So Pankaj, over to you.
Thank you very much, Vikram, and it's a pleasure to be on this masterclass. Thank you very much, guys, for organizing it, especially to ASOCHAM and Meety for doing it. I believe that they are also doing a bunch of other sessions in the future, so please definitely watch out for that as well. Very quickly, as an introduction, I am Pankaj Makkar and I run Bertelsmann India Investments. It is a mid-staged venture capital fund. Our mandate is to make investments in digital sectors across e-commerce, financial services, logistics, healthcare, etc. And BII, which is Bertelsmann India Investments, is part of Bertelsmann, which is a large media services conglomerate based out of Germany. These are definitely very uncertain times. In COVID, life has become quite challenging for most companies, but essentially for startups and also venture capital firms that do fund most of these companies. In these uncertain times, we are definitely looking at supporting companies raise monies. First, of course, going with our own portfolio companies, and I do have about 15 on investments in India, where we are working very hard to make sure that they survive the COVID times and are able to either raise monies externally, internally. There is definitely a fairly large government stimulus that's also out there for small and medium-sized enterprises and financial services companies, and we are kind of tapping into that as well. So overall, I would say, difficult times, but at the end of the day, the VC market has not stopped. Nilesh and I were talking just before the session that the markets are definitely still on, and people are looking at making investments. Even if they take slightly longer to make investments, funding will come. The government has put together a fairly robust program in terms of providing debt to various sectors, and we should definitely avail that if our companies are eligible for that grant and so on. So from that perspective, I think while there are challenging times, there are ways to raise monies, and I think today we do have very good panelists, a lot of my colleagues, veterans from the industry, who will talk about various topics on how they think startups can raise monies, either from funds like themselves or others in the market. And at that point, I'm happy to start the session, and over to you, Vikram, again.
Thank you so much, Pankaj. Now we'll have Saurav Jain, who's the Vice President of Paytm. Saurav, are you there? Saurav, I know that you are having connection issues. If you can hear me, can you please respond? Saurabh may be having connectivity issues, and maybe if he comes back later, we'll have him come back later. Maybe I'll try one more time. Saurabh, can you hear me? All right. So Saurabh is not able to, I guess, connect. Our next person is Rachna. Rachna, are you there?
Actually, I can see all of you all. Can you all hear me?
Yes, Rachna, we can hear you, but we cannot see you. So you may have to speak
Even
from
I
your
am
mute.
not able to see any one of you all, but
Rachna, you can start if you want to start right now. I think.
sure. Sure. Uh, Good morning. Thank you, Vikram, and thank you, Mr. Makar, for giving a start to this session. And good morning to each one of you participants. I hope I'm audible.
Yeah, you're audible. My request to every other speaker is to put themselves on mute while other people are speaking.
So I am Rachna from the National Stock Exchange of India Limited, and I am heading the small and medium enterprise business. I'm heading the small and medium enterprises business development initiatives of NSE. And today's session is very relevant because startups and I think the small and medium enterprises both in this challenging times of pandemic COVID are facing problems not only with respect to working capital and cash flows, but they will also have a long-term financial implications on the way they are carrying out their businesses. So just to give a brief background about what is this platform NSE Emerge that I will be talking to you about and how it can help the small and medium enterprises and startups to look at alternate funding mechanisms. This platform, rightly called as Emerge, which facilitates small and medium companies to list on the stock exchange, tap the public markets tap the capital markets for funding their growth requirements, and then trade onto the NSE Emerge platform of NSE. So today we have more than 200 companies that are listed on this platform, and these companies cumulatively have raised more than 3,200 crores of funds. So that's the kind of platform this is today in place already. And the criteria are very simple for anybody to board onto this platform. It is purely on the paid up capital of the company. So there's no definition followed for an SME or a startup that is defined by the government to list themselves on the stock exchange. Here, the definition of a startup or a SME is very simple. Any company with a paid up capital of less than 25 crores can list themselves onto the stock exchange. So that's it. And NSE has added two more criteria. One is about the track record of the company being 3 years, and the profitability of the company having 2 years of profitability in the last 2 years of their 3 years of operational track record. So simple two more criteria that NSE has added. I take this opportunity to say that this is a alternate funding mechanisms. Generally, in an family business scenario, what we notice is that the promoters would be utilizing their own funds, and subsequently for their other working capital and other capital needs requirements, they would obviously approach the banking channels. But beyond that, very few people are opening up to look at what are the various funding mechanisms. So we know the private equity method is there, the venture capital is there, sorry, the venture capital funding mechanism is there, and also the stock exchange public markets or the capital market funding mechanisms are there. But generally, people do not use this other mechanisms so frequently as they use the banking channels. So my initiative here today is to explain that any company which is on the growth path and has a sustainable business model is a rights company to think, yes, that capital markets could be a journey which they can begin with. And today, while we're talking about the challenging times and about the fund cash flow issues that every company is going to face with, the promoters will have to think hard on how they have to look at the businesses for the future, what are the changes they require to do in their businesses currently, What is that they have to manage fund flow efficiently? So all these questions are going to be looked back at the whiteboard. They have to be brought back to the blackboard, and we have to start from scratch again with respect to how we're going to do the way businesses have been carried out till yesterday. Is it the same way? Are changes required? Because obviously the new normal has set in. So at this point of time, it's very important that every promoter or every entrepreneur uh, understands the fact that yes, there is an alternate funding platform, and I must, while I prepare my business plans, while I prepare my short-term and long-term fund requirements, I must also see, can this mechanism be fitted into my long-term funding requirements? Should I do something today to see that how my this journey towards listing or journey towards capital markets becomes easier and seamless? So what changes should I bring in my company's practices, processes, so that I'm able to tap the capital markets at a later period of time? I totally understand the concern that today maybe SME companies are not ready for an IPO, because obviously the markets are not the IPO timings may not be right. Investors will not be very keen on an capital market funding at this point of time. But it's very important to note that the journey of an IPO is not something that just you decide today and the IPO hits the market tomorrow. It's a process which takes more than 3 to 6 months to finalize, to hire an intermediary, to move ahead and come up with an IPO. So I take this as an opportunity, and I urge all the promoters to look at these funding mechanisms, and while they restructure their businesses, replan their funding requirements, they also look at this alternate funding mechanism of Emerge platform. Most of the times while I am talking about this platform, people or the entrepreneurs are concerned about that, I will have to dilute my equity to list myself on the stock exchange. What is the benefit that I get by listing onto the stock exchange? Do I lose control of my company because I list on the stock exchange? So just 2 minutes, I'll explain all these apprehensions that the promoters have expressed to me over a period of time. And then maybe I can, other panelists can talk about their perspective on this. So, the first thing that a promoter always envisages is that the moment I'm a listed entity, I get under public scrutiny and I lose control of my business. So here again, the clarification or the explanation that I would want to offer is that no promoter loses control just because they are now a listed entity. Because for being listed on a stock exchange, 25% of the equity has to be diluted. The 75% is still with the promoter and the promoter group. So the loss of control fear is not the relevant fear, I would say, for any promoter. The second is about public scrutiny, about disclosures. So SME platform has been put up in a very simplified manner, so that the disclosures are very less frequent as that of the main board. So like if you have a quarterly disclosure on the main board, on the SME platform, you have a half-yearly disclosure. So again, there have been some leeways that have been given to the companies which list on the small and medium enterprise platform, NSE Emerge. The third thing that most of the promoters would say is that they don't see any tangible or benefit arising out of listing on the stock exchange. So I'll just list down quickly some benefits. Is the biggest advantage is the moment a company is listed, they enjoy a lot of visibility, because now your every announcement, your every information is flashed on the public domain. It's flashed on the NSE terminals, and people start looking at your company. They start knowing what is this company into, what business they are, how are they progressing over a period of time. So obviously you become as a right opportunity for people who are tracking you, for tracking that sector, tracking that industry, and then your presence out there on the NSE platform adds you to one more investment opportunity by these investors. So a lot of brand visibility is available to the companies which get listed on this platform. The credibility is very high for a company which is listed, because obviously you are in the regulated space. The moment you are in the regulated space, the trust factor of all the stakeholders is higher on a listed entity than on an unlisted entity, because there are disclosures, there is a oversight body that is actually looking at how the company is performing and what are the investors gaining out of it. So it's very important that the credibility of this company is looked at very differently than if you are not a listed entity. The most common benefit that all my promoters today have told us is that they are able to enjoy better banking terms because they are a listed entity. The moment they approach a bank and the bank sees that, okay, it's a listed entity, they get different term loans at all. They get a different rate of interest for the working capital approach that they have had to the bank. So again, there's a clear distinction between what an unlisted company gets as a bank as a rate of interest to what a company or a listed entity gets while they are approaching a bank for their funding requirements. So even that little bit of bips point that you get as a concession on your rate of interest directly adds to the bottom line of a company. So that's a very important advantage. For startups, I would say, the biggest tool of employee retention, the ESOPs, can play an important role because it's a listed entity. So the moment you're a listed entity, you are able to actually offer ESOPs which have liquidity in the secondary market. So employee retaining talent becomes much easier because ESOP is an important tool to retain talent. Your shares can be offered as collaterals to the banks, and you can actually infuse further capital into your business by offering your shares, pledging your shares with the bank as collateral. So that again opens up various avenues to fund yourself. So it gives you wider accessibility of capital. So these benefits are, there's a Pandora of benefits that a promoter enjoys by being a listed entity. And the framework has been so simplified for listing on the stock exchange that any company desirous to list on the stock exchange has to only take an exchange approval. There is no SEBI approval that is required here. So the process is not only giving funds to the promoter, but it is giving them timely funds, because the IPO process takes 8 months to 10 months to 12 months when the SEBI approval is in requirement. But here, because it's only an exchange requirement, you can get your approvals as fast as 3 weeks to 4 weeks, and you're ready to go for an IPO. So it's not just that you get funds, you get timely funds, which is again a very, very important feature of this SME platform that I'm talking to you about. Startups, we totally understand that the profitability for the startups may not be in place immediately while they start their businesses. So NSE has carved out a different eligibility criteria for technology startups. So any company which is having a 3 years of operational track record but no profitability and is into technology, is a startup company, they can also list themselves on the stock exchange. We have added several other criteria, that there has to be a pre-institutional shareholding by there has to be a pre-institutional shareholding, which will enable a startup to be eligible to list themselves on the stock exchange. So we have pegged the pre-institutional shareholding at 10%. So apart from a 3-year track record, if you have a pre-institutional shareholding of 10% and you are funded either by a QIB or by an angel capital or an angel investor fund, then you can probably apply to the exchange for listing on the stock exchange. So we've carved out a separate criteria for startups to list on the platform. We carved out this criteria somewhere in December, but however, we've not seen any company list on this platform till date. I think everybody's waiting for the right opportunity, and since March, the pandemic has put the IPO activities at least on hold for most of the companies. So that's how it is. But yes, there is an avenue, there is an alternate funding mechanism, and it has been a tried and a tested method. I've already told you 200 companies, more than 200 on NSE and more than 300 on BSE. So put together 500 entrepreneurs have tapped this route and actually benefited out of being a listed entity and tapping capital markets as an alternate funding mechanism. So I thought, this is the synopsis that I could give about this platform, which would be relevant for today's masterclass.
Great. Thanks, Rachna. That was very, very useful. Thank you so much for such insightful, understanding of what NSE is doing and what startups can do. Saurabh, I can see you now. So we can go back to you. So Saurabh is the vice president of Paytm. So Saurabh, if you can say a few words. Saurabh, you're on mute, it seems, so we can't hear you.
Hello, can you hear me now?
Yeah, please go ahead.
I'm Saurabh Jain. I'm Vice President at Paytm. I also manage an initiative called Paytm Build for India. Paytm Build for India is the startup initiative of Paytm. We basically help to mentor startups, as well as we try to give advice to all the various stakeholders in the startup ecosystem. As Paytm being the biggest startup, most highly valued startup, it's our duty to help the startup ecosystem. The other thing is that we try to provide Paytm products free of cost to startups. For example, in Paytm Build for India, we give our payment gateway free of cost till a certain limit to startups. So basically, in the after Corona, I feel that from a startup point of view, funding obviously is drying up. Although we are still hearing about a lot of deals going through and even some big deals going through. But what I feel is that like when I talk to people in the ecosystem, obviously the angels are now not in a very comfortable position because of various factors. The businesses are going down, and the other thing is that stock market has also fallen a lot. For example, my own portfolio has fallen so much that earlier, because I was doing angel investment, but right now after seeing the portfolio, you feel that even stock market is difficult right now. So angel investment seems very risky. So I feel that right now the sentiment is such that most startup entrepreneurs should try to save cash, and to save cash, they should try to minimize expenses in non-core areas. This is a very good time if you want to re-strategize, or maybe you want to pivot and focus on something which can grow better. So this is a very good time for that. The other thing is that personally for me, I have realized that work from home is relatively productive. And for smaller startups, I would say that they can save a lot of cost if they switch to like 90% work from home, and maybe they can just meet even after like this epidemic goes away. Even after that, they can reduce the infrastructure need, and maybe they can just meet in some something like Innovate or 91 Springboard once a week. So I feel that over the long run, this is a good time. But immediately, obviously, there would be a lot of problem in funding. So you would have to bootstrap, and you should try to reduce all the cost. The good thing which I'm telling you is that infrastructure would be required in like less infrastructure would be required right now, because we are all working from home. And I was just seeing statistics yesterday, and the way corona is growing in India, I feel that like it will grow 10x in next few months, because right now we have not been able to flatten the curve completely. So I would advise all the entrepreneurs to be very, very conservative while saving cash. And if it's possible, they can talk to their employees, and maybe they can defer some salaries. And the good news is that some of the sectors are growing due to the lockdown. For example, edtech is growing a lot due to lockdown. Healthcare obviously has got more focus. So if you are into those sectors, obviously it is beneficial to you. But in general, I would say that most sectors would find it difficult to raise money. So at this time, bootstrapping would be the only way. But in long run, I feel that this is the best time to basically run a startup, because if you see history, Sony started after World War when Japan was in shambles. Microsoft and Apple started in 1970s when there was a severe recession in USA and around the world. So generally recessions are a good time for good startups to start, because another thing which will be happening would be that a lot of people would be leaving big organizations. That would be due to two reasons. One would be that organizations would be retrenching people. The other would be, I think, most people work in organizations for money, and when there would be salary cuts, etc., as we have seen in some of the corporate India. So what would happen would be that some of the good people, they would want to become entrepreneurs, and if these good people become entrepreneurs, I feel that the startup ecosystem would grow, because obviously they would require a core team, and some of them would try to merge also with some smaller startups. So from that point of view, I feel that ecosystem would grow in the long run. Obviously, there is a short-term pain, at least for the next 6 months, which is clearly visible. So my only advice is that try to analyze the situation. The other thing which I would like to tell is that many people feel that after 1 or 2 months things would get back to normal. I don't think they will get back to normal. I have read a lot of things about the epidemic, etc. I feel things would take a lot of time, and till we don't get a vaccine or a proper medicine, I think social distancing in some form would be there. So it would be good if we get used to the new world, and instead of thinking that things would get back to normal, so I think like I was viewing a WhatsApp, it was saying BC. So March feels like BC, before Corona, and it feels like that time may never come back, or maybe it may come back after 1 year only. So during that time, you get used to new practices. For example, I feel that work from home is easy if you follow agile and lean practices. Generally, we want to follow the older practices, which I don't think would be good if you are doing work from home. So do try to follow practices like lean startup, agile methodology for development. And online, I feel that people are getting more productive. So try to pivot in case you feel that you are in a very purely offline model. So try to pivot and try to integrate it with some of the rising sectors in the current scenario. So that is all which I would like to tell. And just to reiterate, if we are giving this payment gateway free to small entrepreneurs, you can just reach out to me, or you can go to our site business.paytm.com to get the free payment gateway. Any cash saved during this time would be very useful for small entrepreneurs.
Great. Thanks a lot, Saurabh. That was very, very useful. And thanks for this information on the free payment gateway. I'm sure startups can definitely use this opportunity. Next, I would like to invite my good friend Nilesh Kothari. Nilesh is the managing partner at Trifecta, which is one of the most respected venture debt funds in the country. Nilesh, you have a lot of experience of dealing with startups, and we'd love to hear your views on the subject.
Sure. Thanks, Vikram, and very good afternoon to all the people who are attending the master class. I must compliment ASSOCHAM for having a very well diversified list of speakers today, from diverse startup, but connected to the ecosystem. And then we do have some very successful venture capitalists with a lot of experience, and Trifecta Capital, which is a 5-year-old firm. We're trying to provide alternate capital to startups to essentially finance working capital and capex and things like that. But I'll tell you a little bit about Trifecta Capital first. Like I said, a 5-year-old firm. Over the last 5 years, we've supported nearly 60 companies with about 1,700 crores of loans. Many companies, are large brands, pan-India companies like Big Basket, Car Deco, Cars24, Urban Clap, Farm Easy, Revigo, Blackpark, Zolo Stays, Vedantu. I mean, these are some of the greatest companies being built in this country, and we've supported these companies by giving them loans. to finance capex, working capital, receivables, inventory, and so on and so forth. We just did a little mathematics of a quarter ago, and we've actually helped the founders in these companies save about 3% equity. So one of the advantages of venture debt, which is a relatively newer asset class in this country, as you all aware, venture capital is about 15 years old. Venture debt is about 5-7 years old. Most companies in India will are largely building their businesses by using equity, and which leads to permanent dilution. And by the time founders get to Series E, they own probably only 15-20% of their businesses. And unfortunately, because working capital and loans were not available hitherto, they had to predominantly, largely depend on venture capital or equity to finance their businesses. There is no business in this world, whether it's a bank or an NBFC or a petrochemical or an automotive company, which does not have a combination of equity and debt in its books. And depending on cash flows and depending on capex and so on and so forth, the debt equity ratios vary from 1:1 to 1:4. So there's no reason why startups should only be dependent on venture capital to finance the expansion of their businesses. And in the US, where venture capital is a 50-year-old industry, venture debt itself is a 35-year-old industry, and almost there's about $50-60 billion of venture capital being provided to startups every year. There's almost $8 billion of venture debt, as these loans are called, provided to startups. And companies like Facebook and WhatsApp have all used venture debt, as they've grown their businesses. So, and also, since startups are typically asset light, they're first generation entrepreneurs who don't have a lot of wealth or personal guarantees to offer. The cash flows are generally weak or negative or erratic. It's hard to get loans from banks, and therefore you need specialized institutions like Trifecta Capital that can provide you those kind of loans. And our ability to assess risk in these businesses is not just dependent on financial modeling, but a lot on our ability to understand business. And at Trifecta Capital, we have 3 partners, each of us sitting in the Delhi, Bombay, and Bangalore offices. Incidentally, we are all venture capitalists by training. We've all been entrepreneurs, successful entrepreneurs with exits. And so, given our operating experience, given our entrepreneurial experience, and given our venture capital experience, just allows us to understand startups and what they're trying to do in a way that traditional banks and NBFCs may not be able to do that. Just in terms of when we get involved, given that we lend at roughly half, or our cost of capital is roughly half of that of venture capital. Venture capital notional cost is about 30%. Venture debt is about 15%. We obviously don't take as much risk as venture capital investors do. And so typically the stage that we would get involved is a Series A. At the minimum, there have been a few deals that we've come in pre-Series A as well. But mostly it is Series A and beyond, by which time we expect the company to be in revenue. And by Series B, we expect generally startups to have positive unit economics and so on and so forth. So, I would encourage as founders, look to raise capital to grow their businesses. Please do consider, some amount of debt, maybe in the ratio of 4:1, because unlike traditional businesses, startups will not be able to get a lot of debt. But any amount of debt helps conserve equity. It helps bring down the overall cost of capital. It brings better discipline in the business. So I would encourage all all of you to look at alternate sources of capital beyond venture capital. The government of India has also announced, a few schemes where banks are being encouraged to lend. And banks typically look at about 1 crore to 2 crores of loans. It's still a lengthy process, and it still comes with a lot of caveats. So not very easy to get, but for younger companies who are pre-series A, that's one opportunity to look for some loans. Venture debt providers, in India, and at least as far as we are concerned, we are also giving loans as high as 100 crores. So, we are pretty largish in terms of the amount of loans that we are able to provide. Almost like a mid-size NBFC, if you will. But definitely some of the things we look at and our diligence is similar to what a venture capitalist would do in terms of quality of the founders, quality of the business, market, competitive dynamics, size of the market, opportunity, and so on and so forth. But also a lot of focus on unit economics and positive metrics. And obviously, we don't come in the revenue stage. So just a few things, to remember as you try to build your a business. There are alternate sources of funding available in India today. We in the last, despite of a few things that Saurabh said, we've actually done 5 transactions in 5 weeks. So we are very active. There are obviously our lens is slightly different pre-COVID to post-COVID. We're looking for companies that have withstood the tsunami of the COVID. We're looking for companies that will be permanently be helped by the COVID. Companies in education and learning and gaming and grocery and so on and so forth. These are some of the sectors that have been positively impacted. So we are very active. I can also tell you from my discussion with venture capitalists that they're all ready for business. Their lens may have become a little more conservative, but I'm sure you all heard Khata Book just raised $60 million, very largest ticket size for a company that perhaps I'm told is still not generating a rupee of revenue, and the business model is still evolving. So there is.
Nilesh, your audio is slightly breaking. We can't hear you anymore. Nilesh? Hello, Nilesh? Nilesh, we can't hear you. Hello?
I would think, thanks to COVID, we're actually further in terms of our digital adoption by at least 3 years. So, companies that are leveraging technology and the digital infrastructure in India, including, folks like Paytm, it's so much more easier to build businesses. And so I would encourage, all founders to hang in there. Obviously, if you're on the wrong side of the COVID impact, you need to revisit your business. But there is capital available. It might just take a little longer to get it, but this is perhaps the best time to build a business. Also, some of the structural changes that the government is making in terms of agri, we're seeing a lot of agri-tech businesses being built over the last couple of years. And what the government has just announced in terms of significant, transformational reforms are going to permanently help, agri businesses. So, there are few opportunities which are emerging, and one must keep an eye for some of these opportunities and build businesses around those opportunities. So, good luck to everybody, and should anybody need to learn more about venture debt or Trifecta Capital, feel free to reach out to us through LinkedIn and our website. Thanks, Vikram.
Thanks, Nilesh. That was very, very good. all the attendees, you can see a window on the right side. If you have any questions, keep posting your questions. We'll take the questions towards the end. Our next speaker is Ruchira Shukla. Ruchira is again a great friend, and Ruchira is a regional lead for South Asia for IFC, International Finance Corporation. So Ruchira, over to you. Hello, Ruchira, I think you're on mute. You're on mute, Ruchira. We can't hear you. I can't hear you.
Ruchira, you're still on mute. Somebody from the organizer can unmute her if she can't unmute herself. Ruchira, on the right side, you will see a mic. That is what you have to click to in audio.
Ruchira, can you try speaking again? No, we still can't hear her.
Okay.
She's saying it's a
We can hear you. We can hear you. We can hear you now.
You can hear me now?
Yes, go ahead.
yes,
Perfect.
working.
Okay, so it kept saying muted by the organizer, so I didn't know what I could do. But thank
Somebody doesn't like you, Ruchira.
you. Well, thank you for using your charm to make it happen for me. Okay, so as Vikram said, I lead the venture capital business for South Asia for IFC, which is part of the World Bank Group. And my team does investments in both early stage tech companies directly as equity investments, as well as investments in venture capital funds. And we have about 19 exposures across South Asia, most of which are in India. But we do have one company each that we've invested in Bangladesh and Sri Lanka. So COVID's really been tough, and we know that enough has been said, and we hear in the news every day, not just for India, but all the countries that IFC operates in. China got hit the hardest, got hit first, and then it started spreading towards the West. Spain, Italy, all of them suffered. But what was astounding is the way US has suffered and continued to suffer. And for a long time, India numbers looked very small in comparison. And there were theories like perhaps the heat and the humidity in the country gives us some kind of natural protection, or possibly the DNA of the South Asian genome type is of a type that the virus is unable to harm too much, which meant that we were more robust in how we were made and that therefore would not get hit so badly. All of that gave some optimism for the early part of March and April, but I can tell you the honest truth today is none of that is really protecting us. The numbers are only going straight up, and I'm seeing it not just like all of you as people who listen to the news, but also because my husband is a neurosurgeon who goes into a hospital every day and comes back in the evening and tells me what he saw. And the picture is not pretty. Also, a lot of us see what we see in the metros and the cities we live in. What we often tend to overlook or not notice is how the rural and tier 2, tier 3 locations are getting impacted. So far, those geographies were sort of insulated because everything was starting off and being picked up in the cities. But now with migrant workers moving back, smaller villages are also seeing heightened number of cases. And they are in a much worse position to handle that because they don't have the right healthcare infrastructure. So it is a big problem. It's an unprecedented problem. It's something the world was not prepared for. Having said that, I am one of those people who survived 9/11 in 2001 in New York, was at Lehman when Lehman Brothers went bankrupt in 2008. So I think with those events in my life, I feel that this is the third time the world feels like it's coming to an end, and actually it doesn't. We all will prevail, this will pass, and we'll all come out of it. So the pertinent question today is, what do we do between now and till we're out of this tunnel? And I'll answer it from an investor's perspective as well as from a startup's perspective. What we have seen is a lot of companies in our portfolio, the ones that were running out of cash or that wanted to go out in the market and raise money around this time now, have struggled because the money is just taking longer to come. People still write their business models. The founders are still strong. Nothing has changed about the people or the businesses they are building, but risk appetite has significantly shifted. As a result of that, people go back to their committee once, twice, thrice. Founders are waiting to hear a yes, and it's just taking month after month. In a lot of those cases, IFC and other investors on the board are putting together bridge rounds and trying to support the business till it gets to the point where the other investors, the new investors, can come to a yes. The startups in our portfolio that had longer runway, and when I say longer, I think the ideal runway for such a time is anywhere between 18 to 24 months, preferably 24 months. So if you are sitting on 24 months of cash runway, either because you have that much cash or because you can cut cost and bring down your cash burn to give you that kind of window, I think you'll be fine, because by the time the 18-month runs out, people will come back. The world would have figured out how to handle the situation, and investor appetite will again start to renew. Remember that, as Nilesh pointed out, and as some other speakers pointed out earlier, investors have money. There are funds that have been raised. People didn't expect COVID to come, right? So if you closed your fund 6 months ago, you still have to invest that capital over the next 3 years or 4 years, whatever is your investment period. Those funds are still active and they have to deploy that money. The funds that hadn't been raised, were in the midst of being raised, will take longer to get their corpus together, and they may be more, they may start optimizing how much they can invest and how much they will postpone. So money will come in, it will take time. Decisions will be well thought through, more so than before, and the terms will tend to be more conservative. The terms will end up being more investor friendly because all the investors are solving for their downside. So the founders will have to be a little more humble. I'll urge everyone to be that in this time, because think about the bigger pie you're creating. If you tend to take onerous terms now and dilute a bit, that's just a short-term thing. You will be able to bring an asset that is stronger. Remember, this tunnel is tough for everyone, so not many will not even survive. And if you can stay alive at the end of this 2-year period and emerge stronger because competition has died out, you'll be able to get a much bigger uptick in valuation and much more favorable terms. So the focus right now should be, how do I stay in the game and how do I make myself stronger? The other point is looking at your business closely and thinking about parts of your business as individual P&L sheets and say, is this P&L a positive P&L versus another which is not? Invest in the business that is either the profitable piece of it or has a path to profitability, because that is what is going to sustain you for the next 12 to 24 months. There are businesses in my portfolio that have cleverly added new business lines given the crisis. And I can share one example. So we have Bizongo in our portfolio, which is a B2B platform. They're a B2B platform focused on packaging materials. And yes, like every other delivery platform or e-commerce platform, they struggled in the initial few months because of lockdowns. Their warehouses had to be closed, their deliveries were being stopped. But they were able to overcome some of those operational challenges very quickly. And then they looked across their portfolio and they said, look, what else could we do? There was a huge demand, and there still is a huge demand for PPE equipment and very low quality limited supply in India. So Bizongo very quickly repurposed some of its supplier groups to build PPE to the specs that the company provided, and then got certified. And as of today, they are able to produce about 150,000 PPE kits a day. That's the capacity they've developed. They're serving a lot of hospitals across India, and they're now being approached by the likes of delivery platforms, e-commerce platforms, offices. Everybody needs gloves, sanitizers, face shields, and of course the hospitals need the full PPE set. This is a new business line, profitable business line that the company has put together in 2 months, And I share this as an example of how being agile and being able to spot an opportunity and go for it will still be rewarded in these times. The other point I'd like to make is that in the end, the world will get back to normal, right? So it is about survival. And if you can continue to strengthen your business um, by adding new business lines, by strengthening what you already have, being cash conservative, being smart about people. So people, some of our startups have had to lay off people, but people are a very important talent. So one has to be smart about who you need to retain and who you can let go. And think about that at the end of 2 years, who are the assets that you will need? And then do that in a manner that your people stay attached to the platform that you're building, attached to the business you're creating, and can stay as your valuable resource at the end of this 2-year period. So those are some of my key messages, and I'm happy to take, there are of course other examples, I can come to it in the Q&A session, but I'll pause here in the interest of time and hand it over to Vikram again.
Ruchira, thanks a lot. These were very, very important messages that you gave. And I think I'm sure startups would have learned a lot from your session. And as you said, we'll come back to the questions later. Let me move on to the next speaker. We have Mr. Ramon Roy, and Mr. Ramon Roy doesn't need too much of an introduction. So he's, other than, of course, being the father of the BPO industry in India, and is regarded as a pioneer in the industry. He's also my personal mentor and the mentor for IVCAP Ventures. And of course, I'm sure he's a mentor for many startups. Raman, lots of people here are really looking forward to listening to your views, in terms of what you think of the situation and how you, look at these things.
So thank you, Vikram. I'll try and utilize my 10 minutes focusing more on all the founders who have logged in. I know a lot of investors, both angel investors and VCs have logged in, but let's focus the masterclass a little on the angels. 3 months and the world changed. 3 months ago we were living a very different life. We had different perspectives and where we are going. And with as of this morning, the data said we have about 5.1 million people impacted globally, 330,000 dead, 118 odd thousand cases in India, with 3,500 odd deaths. The world turned on its head. Most of you are probably doing this webinar sitting home, and you never thought you'd have to be locked down for so long. But then as you look at your businesses, there are aspects that you have to look at from a point of view. Are you an existing business that was in production, or are you planning to set up a business? And I think the viewpoint that you as founders have to look at both these aspects is slightly different. If you were running a business has a revenue, business has a cost. You have to figure out whether that revenue is going to sustain. And it is not only that people will take your services or your goods that you produce, but most importantly, will they pay you? Because people may happily take your goods and services, but if they do not pay you, or if they elongate the credit period to such an extent that the money doesn't come in, you will not have money in the bank to be able to meet your expenses. Talking of expenses, you've got to look at the expenses to say, where is the cash coming from? The cash may come to you from your customers, whatever delayed payments there may be, or from the investors. Repeatedly over the last 45 minutes, you've heard people say, Nilesh brought out that we are ready for business, we are open for business. Multiple deals are being done. The point is, will you be able to convince an investor that you have an investable business? Also, will the investor be willing to come in at a valuation that is palatable to you? Or will the investors utilize the tough times and seek a valuation that in itself may not be viable for you? The only thing you as founders have to look after right now is to be able to survive the next 18 to 24 months. The cash runway that you have is super critical. So, Ruchira also spoke about identifying people to say who to let go, who not to let go. I think it is a three-tier aspect that you have to look at from your staff. One is a salary reduction. Okay, first and foremost, who to let go? People who will not be a part of your future, and where the same talent and skills you can pick up from the market may be identified as people that you let go. You cannot say that I will let go 10% or 20% of the people, and whoever is willing to go. The people who will be a part of your future, where the skill set will not be available, you need to be able to identify them. I call them A players. And this is the time where you lock in your A players, perhaps by using your ESOP programs to be able to lock them in to be a part of the long-term future. Then there are people that you will reduce salaries. That's the next tier. It's a reduction. It is not a deferment. You used to get 1 lakh rupees a month, or whatever, 5 lakh rupees per annum. From tomorrow, you will get 3 lakhs, 3 lakhs 50, 4 lakhs per annum. It's a reduction, and you take the risk of whether the employee will stay or not, on how disgruntled the employee will become, because again, disgruntled employees can significantly impact your business. The third tier is salary deferment, to say you got 1 lakh of rupees today per month. You're now going to get 75,000, 25,000 will be paid to you 1 year later, 6 months later, 18 months later. You as founders and your senior management teams have to demonstrate participating with your employees. And if your senior management team and you yourself are taking salary cuts, publicize it so that the employees get the impression that they are in the same aspect. The second aspect is those of you who are aspiring to look for money. Those of you who are looking at pivoting, and again, multiple examples of pivoting have come in. Over the last, 2.5 months, I've interacted with more than 100 different founders and 100 different startups. There are people who've pivoted a business because they were able to create the mass, they were able to do some things. And the question I ask them is that a long-term business for you? Will it get you the aspiration that you want to get? And some of the businesses have come back and said, I have the resources, I have the wherewithal, it is profitable, it allows me to meet my expenses today, but long term, that is not where I want to be. The way you architect yourself, where it is a short-term cash generating opportunity, is very different to the way you architect yourself when you're creating a long-term business. I'm an investor in some businesses who have pivoted to making equipment that is required for COVID, and they see that they were an engineering company, they were making some high-tech equipment. They saw an opportunity to get into make ventilators, very high-tech equipment, and they see it as a long-term option. The way you architect yourself on that long-term option is very different to the way you architect yourself to create a temporary cash flow to manage the issues, to be able to pay salaries and to be able to pay those needs. I've had startups who came back to me in those interactions, and I won't name them because I'm not going to say pleasant things about them, where they came back and say how many people we are feeding. Look, that is a great personal thing to do. I have nothing against it. Use your own money to feed your investors. Even if they told you, oh good you're doing, I can tell you now your investors suffer from a disease called selective amnesia. When it comes to the board reviews, when it comes to reviewing that, they will forget that they told you that you can go and feed people for free utilizing their money where you're not generating a cash flow out of the business. A running business, generating a cash flow, utilizing the cash flow for doing some good is very different to giving equity, getting money in and feeding people. Again, guys, don't get me wrong. I'm just trying to tell you that the investor management piece of this is very, very critical. Last point I want to make as I run into the 9th minute of my 10 minutes. A lot of you will talk about work from home. In this meeting itself, in the last 45-50 minutes, it has been spoken about 5 times. The point I'd like you to think about is working from residence is very different from working from home. A lot of you, like in the BPO industry where you have frontline employees, they are migrant labor. They are white-collared migrant laborers who come to larger towns and cities. 5, 6 of them, 7 of them, 8 of them are staying in 1-bedroom, 2-bedroom apartments in these huge multi-stories that are sitting in Gurgaon and Pune and Bangalore and Chennai and Hyderabad. That is their present residence. Their home is in smaller towns and cities where they came from. If you are able to create a work from home capability where they can save the rental and go home, where they don't have to run a separate kitchen, the cost to them will dramatically go down. That is where you can create a win-win. Work from residences will only, in my opinion, lead to discontent because their ability to work from that area will be very limited, and that will cause impact to your business. So good luck in these tough times. Make the runway go. Make your cash go further. Be brutal about finding ways to make your cash go further. Survival is the only option. Thank you very much. Back to you, Vikram.
Thanks, Raman. That was very, very useful advice. You know, specifically what you mentioned about working from home versus working from residence. I think people don't realize the differentiation between the two. So that's very, very useful. So let me move on to the next speaker, which is Sarika Raichur. Sarika is a partner at Kocher and Company. Sarika, of course, you've been dealing with lots of startups and funds. So, you know, I would love to hear your thoughts and views.
Absolutely. No, thank you so much for the introduction. And, you know, we are all in this unprecedented times, never seen something like this. And I believe that this is the time really to equip yourselves, arm yourselves, and be ready for what's coming in. If anybody is looking to raise funds, here is what we thought that we should put together and, you know, walk you through the relevant provisions of the applicable law and help you you know, navigate through the process as early as possible so that you don't waste any further time in the entire fundraising process. So good afternoon, everyone, and thank you for the opportunity. I would like to specifically thank ASSOCHAM and IBCA and the Meti, to give us this opportunity to speaking to you. I'm pleased to share my views on what startups can expect once they have identified the interested investors for their venture. So we've heard all the industry stalwarts talking about, what they need to do, what are the alternative structures, what are the alternative investment routes that are available to them. But once you are aware of, what you need to do, then comes the legal aspects of what sort of funding routes can be taken up, what's the most suitable route for you, and what are the typical terms of investment that are generally offered to startups in such funding. So moving on to the first slide, if you look at the slide, it broadly categorizes the types of funding routes that are available to founders. If you look broadly, it's categorized into equity and debt. You can see equity shares, compulsorily convertible preference shares. You can see compulsorily convertible debentures and warrants under the head equity. And you see loans as well as non-convertible debentures under the head of debt. So depending on what your business needs are, whether you're looking to dilute equity at that point in time, is it a short-term funding that you need? And like Nilesh pointed out, also with respect to certain slightly advanced stage startups which already have institutional funding, they can also look at loans and non-convertible debentures, which is exactly what the debt route or the venture debt route is about. I have put this, sorry. Is my presentation available? Yeah, all right. So you can see partly convertible debentures has been separately categorized. Partly convertible debentures and preference shares, which may at the option of the investor convert into equity shares, and you have the convertible notes. The reason these have been categorized separately is because from the domestic law perspective, from the local law perspective, which is if there are domestic investors, then these are generally categorized as loans. The convertible note. And when it comes to securities like shares or debentures, which are not convertible, that these get converted, these get looked at as the share capital. So it depends really where your investment is coming from. If there is any involvement of a foreign investor, then the FDI route basically covers anything that is mandatorily convertible into equity shares. So warrants are definitely come under that category, equity shares, and anything that is mandatorily convertible gets categorized as equity and comes under the FDI route. Anything that does not get mandatorily converted, there's a separate set of regulations called as the ECB guidelines, under which, and the debt rules, if it is applicable to you, which needs to be looked at from that perspective. Now, looking at convertible notes, now these are, a specific category of investor instruments that have been carved out in the Companies Act, specifically for startups. Now, what is involved here is if you're not sure about, how, whether you should value your, do a valuation at this point, you don't know at what conversion price these will get converted. This route basically works quite well for you if you're able to get in a single tranche at least 25 lakh rupees from each investor. Now this route basically is only available to startups. Let's see what a startup is. So despite this, the notification by the Department of Industrial Policy and Promotion was first, it came in the year 2016. There are still a whole lot of startups who are still not registered under the scheme and have not taken advantage of the scheme. So let's look at what was recently notified on 19th of February 2019. A startup basically now is categorized as a company which is not incorporated more than 10 years back, or an LLP or a partnership which is not incorporated or registered more than 10 years back. Secondly, in respect of turnover, if it is not exceeded a turnover of 100 crore rupees, that's when an entity can be registered as a startup. entity which is working towards, so basically this entity needs to work towards innovation, development, improvement of products or processes or services, or it is a scalable business model. It has a scalable business model with a high potential of employment generation or wealth creation. And of course, anything that is created by splitting up or reconstruction of an existing business is not considered as a startup. So as long as, if you see, the definition is pretty wide and it allows plenty of startups, the new generation startups looking at scaling up their businesses and creating employment, large scale employment generation and wealth creation. These are entitled to go register themselves. It's a very simple registration process on the website or on the mobile app, and it entitles you to a whole lot of benefits, including the fact that you can also use this new way of raising capital, which is convertible notes. You don't necessarily need to value your company at that point in time. It can be taken as a loan, and the terms of conversion, if you want to convert it, you can have it converted. If you don't want to convert it, it can be repaid. And you can mutually agree on any terms of conversion, right? So let's move on to what you can expect. So once you've discussed with your investors with respect to, you know, the typical what is the price, what is the valuation at which these investors would invest, these are some of the steps that would you know, you can look at doing in the coming weeks. Pitching, then comes negotiations, the basic negotiations with respect to price, valuation, etc. Then you'll be presented with a term sheet. The term sheet would basically cover all the key terms of investment. A lot of times there's a different approach taken by different investors. Sometimes you find really detailed term sheets with all the terms that have been set out, and then it becomes easier to get to the definitive documentation stage. Or you could have bare term sheets with basic terms, and then you can work on the definitive documents, the detailed terms of the investment. You have to undergo due diligence process depending on the size and state of the company involved and how long it has been incorporated, etc. You know, the depth of the due diligence can be determined. Thereafter, you enter into definitive documents such as the share security subscription agreement and the shareholders agreement, along with your employment contracts and any IP assignment agreements. These set out the conditions precedent, and conditions precedent typically include all the approvals that are required, including the corporate approvals that are required by the company or any third-party approvals that might be required. Besides anything that has come out of the due diligence exercise, so any observations, key observations, any key compliance issues that come out of the due diligence process are listed here. Only upon completion of these conditions precedent, parties can move on to closing, and at closing, basically investment amount is wired, shares are issued, share certificates are issued. You make the necessary compliance with the registrar of companies. If it's a foreign investment, then you also file the necessary documents with the Reserve Bank of India. You thereafter comply with all the conditions subsequent. So these are usually conditions which have come out of the observations during the due diligence process, but are not so important or not very critical for closing purposes. And then you have the regular compliance under the agreement, including, you know, information, giving it timely information to the investors, and you know, making sure that they attend the meetings, etc. if they have board rights and affirmative voting rights. Moving on, while these are the typical terms that you would generally come across in your term sheets or your definitive documents, warranties and indemnities, these are basically about you know, how you you know, what is the business about, what is are you issuing the shares in a proper manner, what is the status and the authority of the founders and the company. And this is something that is expected despite the due diligence, because ultimately all the information, everything is, it comes from the founders and the company, and there is no way to absolutely make sure that everything that has been presented is absolutely true and there is no misrepresentation of whatever kind, which is why you have the warranties and indemnities supporting them. Anything, any default or any misrepresentation coming out of the warranties, the whole idea here is to restore the position of the investor as it was if they end up incurring any losses because of your misrepresentation regarding the business or the ability to perform this agreement, or undertake any covenants that you have undertaken in the documents. Lock-in and vesting basically are to make sure that the promoters stay through while the investors are in the company, because they don't invest in the company just like that. It is because of their belief that the promoters are capable of actually scaling the business and taking it to the heights that they've been discussing about. Vesting also in that sense ensures that the promoters really earn the equity. If founders tend make a decision to quit midway, or they feel that there is a reason for the company to remove them from the employment, that's where the vesting clause kicks in and the transfer process, etc., takes effect. The idea is that one should not have dead equity in the company. It has to be earned properly by staying in the company and contributing to its success. ROFR is something that you would always see in investment documents. This ensures that promoter shares are sold only after offering to the investors. Of course, it is still subject to lock-in, so it is only when the lock-in is lifted or waived off can the promoter offer these shares to the investors first, and if they don't take it up, then it can be offered to any third party who was brought to the table. You will also see liquidation preference. This basically helps investors to make sure that they get prior exit. The whole idea of the investment is investors are also answerable to their LPs, and there is a time limit within which the investments need to be liquidated. So this clause basically protects their capital and also gives them prior exit before any other shareholders of the company take an exit. However, it depends. Investors could agree to do it pari passu, or they could agree to a certain order in which exit could happen for different investors. Further, you have the anti-dilution, which helps them protect from any down rounds. So this is something that probably we would see in the coming days. Anti-dilution rights getting kicked in. It is not that it needs to necessarily be given effect to. If the investors agree, then it's possible to waive that off. If there is any down round, that's when this protection really kicks in. Affirmative voting rights and board seat observer rights. Again, it helps in corporate governance and protecting the rights of the investors, making sure, because they are not in the business, they are not conducting the business on a day-to-day basis. They need to be told about key decisions that are being taken. This helps them protect from any dilution or any diversion of business or any undervaluation, etc. Exit rights. This is very, very dear to investors. So the idea here is basically, making sure that they get timely exit while achieving the goals of investment. This comes from the same fact that they have a limited time to make sure that the investment makes money and they get an exit, because they are again answerable to the fund and to LPs. Non-compete, non-solicitation, you would always see this, making sure that promoters do the business only with the company, bring all the business into the company, and also create value for everyone involved. Default, termination, the consequences typically you would see if you do not, if you're in non-compliance of the agreement, or you end up defaulting, not following the agreement to its, the exact intention behind the agreement. You could see things like the drag along right getting kicked in, or you could see a put option wherein you're giving sort of an exit to the investors, or you could possibly also see any change in board members. So the investors could typically have the right to replace board members who represent the founders, so that they can take control of the company. While I have not brought this up, but I think in the coming days, we would see a lot of discussions around the MAC clause, which is the material adverse effect clause, because it has become really relevant in these times. With respect to commercial contracts, force majeure clause, we are already seeing a lot of changes in that clause, many things being put in to make sure that things such as these, the pandemic, which we never expected, the lockdowns, which is completely unprecedented, never seen something like this, and the kind of impact it has on businesses and the ability to execute contracts. So these are some of the clauses, the material adverse effect clause, such that the investors could possibly get a right to choose not to invest if the business it does not look lucrative at that point in time. The clause will be expanded a little bit to cover for such situations. It could also probably apply at a later point in time. Typically, it applies before the investment comes in, but we'll see some changes in the definitive documentation going forward. Any questions?
Sarika,
maybe I can take it up.
Thank you so much. These are really important areas for the startups, especially when they are negotiating contracts with investors. I know that we are running out of time, but we'll try to do best whatever we can. So we have our next speaker with the special address of this session, Dr. Ajay Garg, and he's the director of MIT, and he's been, of course, been very passionate about working with the startups and helping really ease out the problems for startups. So Dr. Garg would love to hear your views on the subject. Thank you so much.
Thank you, Vikram. Can you hear me?
Yes.
Yes, I can hear you.
Thank you, Vikram, and thank you, SOCHMs, for conducting a master class rather than a typical webinar that's being worked around. It's always easy, or it's always very tough to be the last speaker, but hopefully when you have such an esteemed lot of speakers prior to you. But let me see, how do I make little sense in the next 10 minutes? Yes, I agree with all other speakers and all that we are going through a very difficult time in terms of the health and preserving your health, and in terms of preserving your wealth. I hope that you encounter this situation in a very positive way, and you go forward in a healthy as well as in a wealthy way. A lot have been talked about this COVID situation and how it has impacted the economy. Some have compared it to the 2008 recession, some have compared to the Second World War. But in my view, it has been unprecedented in history, the type of recession or the type of situation we are facing today. Only little comparison can be made by the deep recession of the 1930s. And for most of us sitting across or who are part of the participants have never actually encountered that situation, and we do not know how the world actually handled it. So it's a completely new normal, and all solutions that are being talked about or that will be discussed actually are coming without any prior experience of people speaking, and that holds true for me also. We are trying to make sense of the present situation, but none of us can be the best experts to handle it. One thing is for sure, all of you have talked about that conserving cash is a must. There will be a cash crunch. There will be lack of markets that will be there, or markets paying you back in a timely manner to actually handle liquidity. But in addition to this, I'll like to convey one more point. The protectionist measures across the world will increase post-COVID. Countries will try to create deeper boundaries and deeper regulations with regard to giving access to foreign entities. And that's one more concern that we have to keep in mind while handling the present situation. So most of the deep tech startups who look at West as the probable market should actually look inwards and try to look at how do they make sense out of the 130 crore Indian market. Because let's understand, India will be, in spite of all the challenges, India is in the best position to encounter this challenge for two valid reasons. One, we have a least amount of friction with countries to our west as well as to our east in regard to the challenges we pose to them as economy. The second is that we are a consumer economy, and because of the very strength of the large consumer base, we will be able to handle the economic crisis in a much better way than countries with much lesser population. But having said that, let me see that how do you actually make sense of creating your internal market. That internal market is two ways. Look at internal markets and also find a means to look at rupee capital flowing into the investment scenario in the startup space. The venture capital that was flowing pre-COVID, 70% or more of that, or rather larger amount, used to come from outside geographies. Used to come from outside India. The percentage of that will decrease, and Indian capital has to be brought into the venture capital system. If you're talking about the positive of that, the post-COVID, the COVID has done some very good things about the investment and the economic scenario. I talk about both. If I talk about the government has actually, the reforms that have come were pending for years to happen, happened in few days, in spite of most of the officials and the people not working from offices and just sitting at home. I know how many good things have happened to the government. I'll give you a very small example that happened yesterday. We sent for 6 months. We floated what is called as making a VC, or the video conferencing solution for India. Competitor to most of the work from home platforms that are actually going around for all these webinars and meetings. We do not have any robust Indian solution as of date, which is making good money. You'll be happy to note that we did two things differently. We allowed the private player to upfront provide a market to the government. That was, and we, instead of floating a tender or an RFP, we floated a challenge to select the best private player who can be from a very small ideation stage student to the largest of corporates to compete and give the solution to the government. Never thought, I have never seen in my 30 or 25 years of government service this happening, or 6 years in the private sector. This has never happened. The second thing is the type of reforms, the work from home, the regulatory challenges that were there. Discussions between DOT, MIT, industry, NASCOM kept happening. When the situation came, they got reformed in 2 days. The next challenge comes with regard to that, how do you handle the situation? There's a lot of negatives that are happening, but there's positive side to it. The tech spending. Hello. Hello. On webinar. Sorry. And the tech of spending that was happening, the tech spending that is happening will be much bigger in magnitude as compared to what's happening today. It is estimated that the world over, the $7 trillion tech spending will happen to actually encounter the present situation, whether the companies have to invest for making a more segregated workspaces, or with regard to they making their processes more efficient. This spending Part of it, large amount of it will come from India also. But we have to understand two things. Who will be the providers for such solutions, whether they are going to be Indian companies or whether they are going to be foreign entities again. We have to look at it the second way. The large startup community has a capacity, and we have seen to it that most of the solutions for handling COVID has been from India-made solutions. We have not used any outside solution, whether it's an Arogya Setu, whether it's a quarantine tech solution, whether it's a locational application, whether Raman talked about the large number of ventilators. We have been able to develop the test kit at the fastest pace, and I'm very hopeful that the vaccine India or Indians will be a key enabler for bringing a medicinal solution to COVID. So we have to look at it, how do we move from services to products in the software space. We always dreamt of it. The national policy on software products thought of it, but this is the time when this switch can happen from India moving from a services economy in the software space to a product economy. This is the best time to happen, and I'm sure if we all play our cards together. The important factor in this is that we have the capacity, we have the innovation capacity to make products, but we have not built a capacity of investment from India to make it happen. Many of them which graduate from here actually are companies in somewhere outside India, if 5 to 10 years down the line when the scale up or maturity happens. We have to actually rejig this. Now, in regard to advice to the startups, I have one basic advice. In times of crisis, every human tries to go back to their alumna mater. A child goes back when he's matured enough, but he's in a crisis, goes back to his parents to seek help. They are the first providers for such help. For a startup, you have to be careful about two things. One, if you are in a crisis, you want to do fund crunches, you want to rejig your solutions to make them remain effective post-COVID or create a bigger market impact post-COVID. Your incubators are the best choice where you can go back again, rejig your whole strategy and your solutions, and come up in a new enthusiastic scenario back into the market. The mighty startup hub that we have created, and where we take help from the industry and from all stalwarts like you, can provide an interface between you and such incubators. We support around 150 incubators, and we have a connect to 300 incubators. So I request you, think about it, come back to the right incubator once again. You will lower your cost on real estate. You will lower your cost on skills, because most of these incubators are connected to large research or educational institutes that can provide you the manpower and the right tech support at a much lower cost. The other important thing that is there is that with regard to venture capitalists, Sarika talked about about a combination of a debt and an equity fund. In India, the challenge is that either there is an equity fund or there is a debt fund. The equity fund will be reluctant to actually invest at this time because the risks have become much higher. Complete debt is an impossibility in this time because of the collaterals that are required for such funds. Now the time has come for ventures to think about a short-term combination of a debt and an equity fund. And if required, please advise us that there has to be an element of grant from the government to cover the risk. And this can be a method by which a short-term liquidity crisis can be handled. I recently had a presentation, I think Raman is part of it. There is a fund called ACT in Bangalore, where they have created a corpus of 100 crores. And the good thing is that 40 crores have already poured out of it in the last 1 month. The speed at which it works actually makes it happen. A pure funds from whether from the SIDBI or DPIITs or governments, the processes, no matter we have reformed ourselves to a large extent, but don't believe on us. It has to the private players that have to actually act, and government can be only an enabler or a facilitator. That is the way I look at things in the post-COVID world. Most of the things or the controls or people looking towards a system to reform has to change to a place where the private sector has to force the system to reform. This is a new world, new challenge, but the opportunities are huge. We have the talent, we have the innovation capacity, we have the market, and we have the right set of large corporate sector ready to look at the world differently. Thank you. Thank you once more.
Thank you so much, Dr. Garg. That was very, very insightful, and thanks a lot for giving such interesting ideas. And I think you're absolutely right about the ways, like this debt and equity combination, and I think that's a good idea for funds to work on. So I think of course, so we have run out of time already, but I would maybe still, if with everybody's permission, maybe just take 2 questions from the audience, and we have quite a few questions. Of course, we can't take all of these questions, but I'll just take 2 questions right now. The first question is from Anup Rai, which says most of the investors or VC funds they invest in top tier cities. Please tell us how to connect or receive funds for innovative projects from tier 2 or tier 3 cities. So I think that's an interesting question, and maybe Ruchira, you can also answer that question. I guess you have alluded to tier 2, tier 3 towns during your speech. So what's your thought on that?
Yeah, so you're right that there is a reason why a lot of VCs are investing in businesses that seem to be centered on tier 1 or metros. And I think it's not because, actually it's a little of both. It's partly because the VC feels more comfortable at the early adoption these markets give to the product or services that are being created. So if your platform is such where your early customers are in tier 1 metro cities, by definition, if your VC is backing you, it appears like he or she is backing a metro or a tier 1 based business. But it's not that the VC is telling you should only be selling in the metros. It's you who are deciding what your product and service is, and you who is deciding where your target customer sits. As far as IFC and World Bank Group is concerned, we actually need to show impact to our board. So when we come in as investors, it's actually one of the questions we ask our management teams that tell us how much of your business is being done in metros and tier 1 versus tier 2, tier 3, low income states, the under-penetrated geographies or the underprivileged segments of society. And that's a metric we track not only at the time of our investments, but throughout, even after we've made the investment. Every quarter we track that metric. And I would say that it's perhaps more pronounced for us because we are part of the World Bank Group, and impact is a very important piece of what we do this for. But almost every VC will want you to have a larger market. So nobody will say that you should only be in tier 1 or metros. You as a founder should be deciding where your target group is and building your service so that it reaches the maximum number of people.
Great. Pankaj, do you want to add to that? Pankaj, you're on mute.
All right. Yeah, I think just adding to what Ruchira is saying, I don't think at venture capital community perspective, we have a view that we will only back companies from tier 1 or tier 2 cities. If there are business models that work in smaller cities, And I would take, for example, even education and agriculture technology business, which mostly focus on tier 2 or villages. All of those are businesses that have definitely been funded by venture capital providers all the time. So I don't think that is at all a distinction that at least most of the venture capital would kind of think about at all.
Sure. So I'll take the last question because I think we've overshot time quite substantially. This is from Soumya Shukla. She's saying that most of the companies have recently started taking decisions that majority of their workforce permanently work from home. And I think she's struggling to understand why remote is more efficient in the long term. Raman, do you have a response to that?
No, there are multiple aspects of, efficiency wise. If you're able to get the same productivity and you're able to get the same empathy, etc., financially, yeah, it makes a lot of sense. You don't have to pay rental, you don't have to pay air conditioning, you don't have to set up the cafeteria, you don't have to, IT and BPO industry, we transport employees. Over and above the salary, 30% of the cost goes into transportation. So financially, it makes a lot more sense. And if, my view of working from residence to working from home, if the same employee was working in a smaller town and city, in Indore, a Panipat, etc., he or she may be willing to take lower rent because there are no rental expenses, no kitchen expenses, etc. He's going to sit in his family home and he's going to eat his mother's cooked food and so on. So there are a lot of advantages of that commercially, financially, but to implement it is a challenge. We as a country have a lot to do to be able to implement it. I'll give you an example. Some of these kids from BPO working together, the electricity guy comes to look at the meter reading and he says, oh, you're working here. And they get a notice saying that now you have to pay commercial rates for electricity. Hey, excuse me, what happened? Next is that the house tax will have to be commercial house tax and not the house tax. And many years ago, not COVID, I'm talking about 12, 13 years ago, where I was talking to the government to make work from home a reality at that point of time. And I was speaking to a very senior government official to say, but I work from home. I have to open the laptop and I can work from home. And he said, Raman, don't say you're working from home. That is illegal. Say you're doing email from home. That is allowed. So, there are a lot of things that have to be done. Work from home, I think, can take the next million jobs to smaller towns and cities where that salary or the money that is coming in. Because again, if you're in smaller remote town and city, you may not pay salary, you may pay per transaction. And then you have to pay GST or not pay GST. So a lot of issues need to be resolved, but I think that is the future. There is no option. We cannot put this genie back into the bottle again. And I know I'm personally working with the government to resolve some of these things and take it from there.
And it will perhaps also lead to sustainable living.
Yeah, that's a
Yes, I hope it does. I really hope it does.
So great. Thank you so much. It was a great session, and I just wanted to. I know that we've overshot on time, but I just wanted to take just 2 more minutes just to wind this up. And I think I wanted to thank Pankaj for his inaugural remarks, and I think very well said in terms of focus on your current portfolio. Investors are still investing, so I think one needs to really keep looking for good opportunities. Thanks, Rachna, for talking about the the NSE Emerge platform and the alternative funding mechanisms. Despite the apprehensions in terms of loss of control and exposure and scrutiny norms, there are lots of advantages in terms of visibility, credibility, and better banking terms and retaining talent. So I thought that was quite useful. Thanks, Saurabh, for really talking about some of these initiatives that you guys have started. For example, free payment gateway for startups. I think that's quite useful. And also on your comments in terms of which startups are really going to gain. For example, tech, healthcare, talked about that, and also pivoting from the offline to the online world. I thought that was quite useful. And Nilesh, thanks a lot for really highlighting debt as an alternative way to really fund your businesses. And given the fact that it's a new asset class, I think it's a very useful asset class for the founders. And of course, one can explore this, and given the size of your funding, startups. Ruchira, again, thanks to you as well for really giving your perspective, and also, what startups should be focusing on at this time, what kind of cash flows they should have. They should have a runway of at least 24 months. The risk appetite of investors has significantly shifted, so therefore startups need to hold on and need to really work hard at this time. Raman, of course, you've been very, very, specific about, things like cash or cost rationalization requirements for startups, especially in terms of the employees and, what costs to cut and what not to cut, and the three examples of salary reduction versus salary deferment. I think that was very, very useful, at least, for me also personally to understand. And Sarika, I think that was a very, very useful presentation that you made in terms of understanding specific terms for startups. Many times they don't really and while negotiating with investors. And Dr. Ajay Garg, you've given us a lot of confidence even in this session to really, think of various ways on how the government is trying to support through various measures. And example of how government is prioritizing, giving work to Indian startups, and your example of that video conferencing area specifically, I think very, very encouraging. So with that, I would like to thank all the speakers and really appreciate your time today. And thank you so much for all the participants to be part of this master.
Thank you.
Thank you.
Thank you.
Thank you, everyone.